Welcome to Investing for Beginners podcast. Today we're going to do a Q&A session. We got 3 great listener questions that cover a wide range of topics, and Andrew and I thought this would be a fun conversation and also help you learn a thing or two along the way as well. So who could beat that? Fun and entertainment and education. That's hard to beat. All right, so here we go. Hi, Dave and Andrew. I've been investing for a couple years now, and when I started, I opened 2 accounts in Wealthsimple, one RRSP that's managed and one TFSA that's also managed. About a year ago, I started investing on my own, buying stocks through an RRSP, and things are going pretty good. Now I just found out that it's probably better to do this in a TFSA as I'm 35 years old and have a long time till retirement. My question is, do I sell my stocks that have been compounding over the year and restart in the TFSA, or do I leave it there and just restart in the new TFSA? Thanks so much for all the information you give to us. New to this, and this is from Freddy. So obviously from Canada. 2 accounts he's talking about are Canadian retirement accounts. And so with that, let's help answer Freddy's question. So what are your thoughts, Andrew?
Yeah, thanks for writing in, Freddy. Thanks for giving us the question, and thanks for being a listener. We really, really appreciate it. And this is a great question. So I'm US based. I don't have experience with a RRSP or a TFSA, but from my understanding and doing some research, an RRSP is very similar to a 401k here in the United States, and a TFSA is very similar to a Roth IRA here in the United States. Both of those give you tax advantages for retirement. The difference is when you get the tax advantages. So you get the tax shield on the RRSP. When you put the money in, you get a tax shield. And then when you take the money out in retirement, then you're taxed. The TFSA, it's flipped. You pay the tax on the money, so you put in after-tax money, and then that's when you're taxed. And then the shield comes when you pull the money out, you are not taxed at that time. Again, like a Roth IRA. So the question here, I think, is twofold. It's what do you do with the money that you have in there right now? And then what do you do with any new money? And so I'll talk about what I would do. What I would not do is just roll over money from a RRSP and put it into a TFSA before first learning if that's the right thing to do for my personal situation or not. So I'm going to guess, and I'm not a Canadian. I didn't side hustle in Canadian taxes, so you'll have to forgive me for not giving you the most accurate information on it. But I would guess that you would probably take a tax hit if you wanted to convert from an RRSP to a TFSA, because if you did that in the United States, that's exactly what would happen. So you have to ask yourself, if I want to make that conversion, am I willing to take that tax hit? Am I willing to pay those taxes in this year in order to basically, by doing so and by deferring that, you are getting compounding benefits on the money. So you are probably going to make hundreds of thousands of dollars in tax savings if you really do have like 30 years till retirement. So it could probably be a great financial move. But you do have to pony up. If you were doing it in the United States, you would have to pony up. And that's not always an easy thing to do, even though we might know that it could make us $1 million in 30 years. So that would be the first thing I would say, is it very much depends on your tax situation, your own personal temperament, and if the cost benefit between the emotional cost, the financial cost, and then the benefit, if those outweigh, then yeah, you might consider doing that. But just because, I should have done this in the first place, I would not use that as a reason, not only because of the tax implications, but because it's kind of also a FOMO mindset. As much of the FOMO we have to deal with being investors, looking at the stock market, seeing these businesses that just explode out of nowhere, I don't want to add another FOMO to your list. Do you have thoughts on that part?
Yeah, you don't want to add another FOMO to the list. I would agree that moving the money from the RRSP to the TFSA just cause is not a really good reason to do it. I would probably hold off on that. And for several reasons. correct me if I'm wrong, but if you will try to do this here in the United States without a legitimate reason, i.e., you left the job and you are trying to take the 401k air quote with you, you can do that here without being penalized for it once a year. But I don't know how the rules work in Canada. Again, I did not do a side hustle on taxes and retirement accounts in Canada, so I'm a little short on knowledge of this. But just functionally, like Andrew was saying about the FOMO part of it, uh, I don't. I also would question if it's only been in there for a couple years, how much money is there really in the grand scheme of things, right? So just to use easy numbers, if you're 35 now and you're going to retire in 30 years, the 30 years of compounding that you're going to get on setting that money aside now in the account you think is a better fit for what you want to do is going to far outweigh the process and the headache and the stress of moving a much smaller amount to the account you have now. And so I guess I would probably, if it was me, and I'll just throw an easy number out. Let's say it's $1,000, just for easy rounding. $1,000 is not, in the grand scheme of things, is not worth a lot of heartache and stress and headache about. Yes, would it be nice to have everything all in one umbrella? Of course, that would be very nice. We just talked about, apps and super apps and combining things in our last show. And if you think about that with brokerage accounts, yes, it would be awesome to have everything under one umbrella. Unfortunately, life doesn't always work that way, and situations happen, and you just got to deal with it. So, my opinion would be to focus way more on what you have now, the TFSA going forward, and depending on what the rules are in Canada, let's say that you're in a job and 7 years from now you leave that job and you want to roll that money into the account that you have now, then that's a perfect time to do it, and it's a bigger amount of money, and it makes sense to do that. When it's early and maybe it's a smaller amount, I'm just guessing, so I don't have the information. But if it's a smaller amount, is it really worth, your time is valuable, right? And using that time to focus more on your family, your job, your hobbies, or other things you could do to create more revenue for yourself, I think that would be more worthwhile than stressing about whether you still have four stocks in an old account and you got all the other stuff in the new one. That's how I think about it.
Yeah, perfect. Totally agree. I guess the second part to this is, do you put new money in the TFSA or do you put new money in the RRSP? And I found a great flow chart on Reddit, which is completely useless for all of us since you're all listening and not watching. But basically, it can come down to, just like here in the United States, is what we tell people. Evan tells people a lot. If your employer gives you a match, so for example, you're going to put in $100 in the RRSP, they're going to give you $100 match. Always take as much match as you can. That's 100% free money. It's hard to double your money in the stock market. It's a lot easier to double it if a company is matching you, your employer is matching you. So take that. And then the discussion on whether to go RRSP or TFSA after that is really personal preference. And I think how Dave answered it is a better answer, because you can go into things like, oh, well, how much money am I going to make now? How much money am I going to make in the future? Whether tax rate's going to be now, whether they can be in the future. There's a lot of factors. You can go down that rabbit hole. There's a lot to be said for simplicity and just doing enough to continue making progress.
Sorry, I had my cough. I 100% agree with that. I think you have to decide what kind of investor you want to be and what's going to work best for your situation and how much work you want to put into this. And again, not knowing the ins and outs of an RRSP, if it only allows you to invest in index funds, for example, and you really want to buy individual stocks, then I think that answer is pretty simple. If it offers you a match and it offers you a match in company stock or other index funds, that's, like Andrew said, it's free money. You got to take it. And maybe you use that for your free money part and you invest everything else into TFSA. So depending on how you have things set up, you I think you just need to figure out what, like Andrew said, it's a personal situation. So what Andrew may do versus what I may do may be different, and what we tell you to do may be different than what you may want to do. So I think before you make any decisions, think about what it is you want. How do you want to go about doing this? And depending on if you have the option to do it, maybe talk to a retirement account specialist or somebody along those lines to give you a little bit of guidance on the tax rules and how that could impact you now as well as when you get to retirement, and kind of set yourself up, and then you can go from there. But I think the more knowledge you can accumulate, the better decisions you can make, and also just spending a little bit of time thinking about what it is you want and how you want to do this, and then you can make choices from there.
How do you do that? That's a crazy idea.
Well, actually, you go on TikTok and you find out what everybody else is doing, and no, I'm just kidding.
Right.
Just kidding. Just
My
kidding.
favorite platform.
Right. Or you go to Reddit and you see what everybody's raging about, and then you do the opposite thing.
There you go.
All right. That was a great question, Freddie. I hope that helped answer your question. So let's move on to question number 2. This is from Boz. And the question is, Adobe stock looks cheap compared to its historical valuation. What underlying factors should I consider to determine if it's actually undervalued or if the market is pricing in real risks? Is it a falling knife? Great question. And let's talk about Adobe.
Oh boy. So we
Yeah,
both
right.
own this,
We
to
do.
be clear. Okay. We both own this. It is how do you interpret how the market has been treating this stock since we bought it, which was in the summer?
I think there is unquestionably a lot of fear around AI and how it could impact Adobe's business. And I don't feel like Adobe has done a stellar job of quelling those fears through their not only their investor relations, but also what they've relayed to analysts during earnings calls. They have certainly not been bearish, but they've also not been like, this is how we're beating it. And so they've kind of been, this is just my interpretation. I feel like they've been kind of ignoring the elephant in the room and not really addressing it head on and saying, this is what we're doing. This is how we're going to beat it. It's more like, these are all the things we're doing. This is business as usual for us. And like kind of nothing to see here kind of thing. That's how I feel. Now, whether or not that's how other people interpret it, I'm not sure. But I certainly feel like the market is punishing them for what could happen with AI and how they think AI is going to impact Adobe's business. What are your thoughts?
I think that's a good evaluation of it, and that would make sense. Just to break down, if you're not familiar with Adobe, they have all these different marketing products to help marketers do things like create marketing materials, create brochures, create that sounds really 1990s, but create infographics, create PDFs, create all these things that a company could want or use. And you are seeing the AI, the photo image generation is very, very impressive when it comes to AI. And the big argument with AI is we're just getting started. The AI is going to get better and better and better. And with image generation, it has in fact happened as well, where now you can edit images pretty nicely with AI, where it didn't have those capabilities just a couple years ago. So Adobe owning Photoshop and some of the other related kind of things for photographers. They also own software for video editors and all these different software suites. I'm not going to go down the list, but to your point, there's this perception that this disruption is coming for Adobe, and that's why you see the stock pretty low. It appears that maybe that this is hitting some sort of floor for the stock. One of the interesting things about the stock market, which you'll learn over time, we're talking about stocks that are falling knives and stocks that maybe are hidden gems, is the whole basis behind value investing and buying companies cheap is that at a certain price, every stock looks attractive enough. At a certain price, there becomes a floor for a stock where people just say the numbers are just too good here that I don't care what the narrative is, I'm going to buy. And so you look at all the different falling knife stocks, the ones that, I mean, maybe there's survivorship bias here, but the ones that have survived, you can see a floor in the stock chart where all the people who believed in the company had left, but the people who were buying from who were left buying the stock were the ones who were looking at the numbers and saying, look, I don't care. I don't care if this business sells melting ice cubes and that's their business model. I see $100 million in profits or whatever it is. And so at this price, this stock's a good deal. So you do see that. And when I look at the stock chart for Adobe over the last 4 years, I wonder if this is kind of like that floor. It hasn't quite hit the 200, and it had dropped below 300 back in 2022. But definitely the PE continues to go down, 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 continues to compress. So from a numbers perspective, the company looks great. The numbers still look great. I guess to me, the bigger question, and I wonder if where you feel about this, I kind of drives me a little nuts that people never make this distinction, but whatever. I'll just let it roll off my shoulders. But is this a distribution story or is this a technology story? Because you have technology companies that are not necessarily technology stories, but more distribution stories. You know, as much as there's so much hate about Apple and their ability to innovate, the fact remains that when you go to buy a cell phone, you have the option. You go into an AT&T or a Verizon, and you have the option between Android or iPhone. So there aren't like a million different competing options there. You have to go to the distribution place. You go for grocery, you have the option between Johnson and Johnson consumer products, or you have Procter and Gamble. It's a distribution. There are a few distributors that are the choke point of the industry, and if you are with them or not, it has a larger, to be frank, it has a larger economic impact on those businesses than, oh, well, did you see the innovation of their laundry detergent? Oh my goodness, this startup has so much better laundry detergent. They're gonna take Procter and Gamble's business, right? No, you don't see that. So when it comes to Adobe, and this is still a very new thing because the internet's new, you know, we're only talking about 20, 25 years, software companies, things like that. Has this industry turned into a distribution story rather than a technology story? And if it's still a technology story and the better tech will win, then we'll probably lose on this investment. We'll probably won't keep up with the market if it really becomes who has the very best tech. But I would argue that investors should consider maybe this is a distribution story. Maybe they have their tentacles in so many of their enterprise customers that the tech can be the tech and they can build whatever customers want, but they have the customers.
Right.
That would, I guess, be my impassioned rebuttal to what's going on with the stock price in Wall Street and why I still believe in Adobe.
Yeah. I would agree with all those things. I hadn't thought about that question about whether it was a tech company or whether it was a distribution company. My instinct tells me it's a distribution business, that the technology that they create, while it's great, I don't know that that's really the strength of why they've been as successful as they have been. We both are users of Canva, and we know that Canva has pretty good tech too. But I would say that based on Adobe's integration with so many different industries that utilize their technology, their platforms, that's really the power of Adobe has been the distribution of their technology. And the fact that it's used in design schools, it's taught in, art schools, all these places that those people go out and work in the professional world all know how to use those platforms because they're taught them in school And then those platforms are also used in the professional world. Our friend Brandon is works in the photography industry, and we've talked a lot about Adobe with him. And several of the things that he's told us have been that the company is certainly integral to a lot of what they do. And yes, AI is unquestionably chipping away at parts of those businesses. What Vanity Fair recently had a photo shoot that was all digitally, it was all AI created, and it created quite a stir in the fashion world. And those are things that Brandon is concerned about in his industry: is how much is AI going to take away from us? But there's also the question of the editing of the images and all the other the all the other parts of what goes into creating a magazine. Is not just the taking of the picture, it's also the rendering and the different editing that they do to the pictures to optimize them as best they can. To my knowledge, a lot of that can only be done via Adobe. And those tools are integrated very closely into that whole industry. And you think about the design industry, not just for like images, but you think about any sort of graphic design or any sort of images that we see on the internet, or even in the building space. They use Adobe to help render what buildings will look like, to help raise money to build the building. And so there's a lot of different aspects of it. And I think when I think about the business, to me it feels very strongly that it's a distribution business, that the software can be commoditized over time, and we've seen that happen. And in other industries, and I don't see any reason why it couldn't be in this aspect. So kind of to your point, yes, AI can definitely create some pretty amazing stuff, and it is going to get better. The more that it does, the better it's going to get, unquestionably. But there's also the distribution part of that, and how much access do people have, and can they do all the things they need to do with that, just with the air quote taking of the picture, so to speak, with the AI generation. So I I think we're a little premature on the. It feels like the prediction of the demise of Adobe is a little premature. We could be proven wrong for sure, but it just feels like, to Andrew's point, when you look at the numbers in fiscal, and look at their just the top line numbers, revenue growth, margins, it all looks perfect. It hasn't changed. And
Yeah.
even though the stock price is, ugly, that part of it is not. And so if you were starting to see some disruption, if there was disruption going on, you would think it would start to play out in the numbers, and it doesn't appear that that's happening yet. And it feels like the market is anticipating what could happen, but it hasn't happened yet. And I guess the other thing just kind of popped into my head. Andrew interviewed David Gardner recently, and one of the things that David talked about in his book was the snap test. And basically, what he means with the snap test is, if you snap your fingers and that business to exist, how much would that impact that industry? And you think about, if Adobe went away, just boom, it's gone. How much would that impact? Could AI fill that spot? No, it couldn't. And so when you think about that, to me, that tells me that that this is all a little bit premature. So I don't feel like it's a falling knife. I feel like the market is offering people an opportunity to invest in a potentially great business at on sale.
Yeah, and let's talk about the falling knife, and how would an investor determine that, just on a broad level. One little tidbit I just want to I just have to throw it in there. I can't help myself. Diluted shares outstanding down 5% year over year. So that's a 5% growth rate in the earnings per share just from buybacks. So I think they're doing a pretty decent job of taking advantage of what's been happening with their stock price. So I always like to see that. But anyway, I digress. I'll stop defending Adobe, I think. How can an investor determine, lots of potential falling knives out there all the time? You see them every year. There's always one or two or six or 20.
Mhm.
How can an investor determine whether those are falling knives or hidden gems when they see one?
I think for me, it's understanding what the business is and what they do, and is something changing in their industry slash sector that's causing people to start think, okay, this company is going in the wrong direction. If you think about GameStop before it became a meme, um,
Yeah.
the company was unquestionably a falling knife. If you looked at the financials, they weren't going in the right direction. The narrative about the company was that they could hold on, but if you looked at the financials, they were telling you that it was not going to be able to hold on. And the company was at the time trying to pivot into a different segment of its business away from selling games and recycling, games and units, the machines that you play the games on. I'm going to blank on the term, terminals, whatever you call them.
Consoles. Yeah.
Thank you, consoles. Well, anyway, so as those started to fall, the company was trying to switch to a different business model, and that wasn't going well. And but the company was trading at a super low PE, had a super high dividend yield, and those things were attracting value investors. But it was really a value trap because the company was dying, and they were trying. They were like, think about it, somebody that's struggling in the water to swim. That's what it felt like Adobe, GameStop was doing. And so I think when you're trying to determine whether it's a falling knife or not, I think the two things you really need to focus on is what's happening with the business and what's happening with the industry or sector they're in. And if one or two of those things are going the wrong direction, chances are the business will too eventually. And so that's why you really need to think about what is going on with the business. The classic example, of course, is what happened with Netflix and Blockbuster, right? And that was unquestionably a falling knife, but people didn't see it until it was too late. So I think you have to realize if something comes and changes the industry, then if that company is not able to adapt or pivot, then eventually it's going to go down. That's the nature of capitalism. And so I guess I would look at what's going on with the financials and what's happening with the industry and the sector. That's how I would kind of view it. What are your thoughts?
I don't have much to add. I think those are good. Just to pull on that thread a little bit, are there numbers that you can lean on that maybe don't tell you exactly that this is happening, but can start to compile that evidence that, hey, things are not going in a nice direction here?
ROIC is always a good one to look at. If you're seeing that start to go in the wrong direction, that could mean that the company is inefficiently managing its capital, and that will ultimately lead to a downturn or a falling knife of a business. That's one place. If you see debt loads rising, but again, correspondingly, the ROIC is going in the wrong direction, that's not a great place to be either, because the company is taking on more debt, which could lead to riskier investments for the business. And if there's any sort of downturn, then it puts the company in a very precarious situation. So those would be two things. The obvious ones: revenue going the wrong direction for a sustained period of time. I'm not talking like one quarter it's down and it bounces back, but if it's consistently going in the wrong direction, margins, if they're starting to go in the wrong direction consistently, then those are definitely signs that there's something's up.
Yeah, I love it. What about on an industry perspective? That's obviously a much harder question, but are there ways you can start to see signs?
I think if you start to see those signs in more than just one company. So let's use the airline industry just for ease. If you see United and American Airlines starting to trend in the wrong direction and maybe Delta is flat, then that could be a sign that there's something going on in the industry. If only one player is struggling, that could be internal. They could be just making bad decisions, or they've set their business up wrong, or they've just made poor choices. But if you start to see more than one company in the industry start to go in the wrong direction, then that could be a sign that there's trouble. And if you see all of them in the industry going in the wrong direction, that's you know, prime grade, red flag warning. Hey, there's problems here. Alert, alert, alert. So I guess that's kind of how I'd look at it.
Yeah. Yeah, that's good. I remember very painfully. One of the worst mistakes I made was buying Franklin Resources, and they've always generated more revenues from doing active management. And so when you saw them and some of their other competitors that were also in active management going poorly, that really was the first signs that the index fund thing was really taking a lot of market share. And in hindsight, it looks really obvious, but I wish I paid attention to the signs back then.
The signs are everywhere, right? Yeah, but they could be hard to read for sure. So that's why, it's not a hard science. There's certainly, I think,
Right.
some art to it, and that's also really understanding what it is you own and trying to understand. I guess something I've been thinking a lot about and trying to figure out a way to implement it is use the Charlie Munger idea of, like, destroying your babies, right? Like, how can this go wrong? Invert the problem, and what could make this go wrong, and then maybe that's how you could try to anticipate some of these things. But again, it's not a perfect science.
No, it's certainly not. That's why, believe it or not, it requires a little bit of work.
Right.
A little bit of work, a
Yeah.
little bit of expertise. Yeah.
Yeah, there's definitely some expertise that needs to be had for sure. All right.
Sorry to burst your bubble.
All right. Womp womp. All right, let's move on to the last question. So, can you do one of the explaining thoroughly the cost of equity for us? A concept a lot of investors, especially young ones, don't understand. So, great question, and let's pull apart cost of equity. What are your thoughts on cost of equity?
Yeah, thanks for writing in, John. This is a good, or I guess commenting. Yeah, thanks for commenting. This is a good comment. Whew. What is even the point of doing cost of equity? Maybe I could start there. When you buy a stock, what you're doing, I'll try to make this brief. It's You are trying to decide, do I want to put my money here or do I want to put my money there? Do I want to put my money under a mattress? Do I want to put it in a savings account? Do I want to buy this stock? Obviously, if you buy a stock and you decide to do that instead of putting it in a savings account, you're hoping that that stock earns more than if you just left it in the savings account, because the savings account was basically zero risk option. The stock is going to have more risk, but the idea is if you buy enough stocks, you're diversified. And so on average, all of your stocks will return much higher than the savings account. And so many of us understand that risk and we accept it. And that's the table stakes for investing. And that's why we invest. That's really what it comes down to. Cost of equity is the mathematical representation of what I just try to represent. This thing that goes on in our brain. Cost of equity is an attempt and a metric to try to describe it. And if that already makes you a little bit upset, you are totally fine, because you're like my wife. She was like, "What is WAR?" We were talking about baseball. She's like, "What is
Right.
WAR?" I'm like, "Wins above replacement." She's like, "Well, how's that stat calculated?" I was like, "Well, it's kind of theoretical." She's like, "There's a theoretical stat that's so stupid," and I'm like, "No, it's not." But if you think cost of equity is stupid, like, more power to you, because it is seriously trying to calculate something that's very hypothetical.
Yes.
But that cost of equity is trying to tell us what the opportunity cost is for the risk we are taking for buying the stock. So if I'm buying the stock, and I'm really simplifying here, you can go so deep into the weeds. But if I'm buying the stock and I say to myself, my cost of equity is 8%, then if I am buying that stock, I'm basically telling myself that I expect the stock to earn at least 8%. That's one very oversimplified explanation of cost of equity. You can also look at how risky is this stock, how uncertain are the cash flows, and that can play a part in the cost of equity as well. You can play with cost of equity in so many different ways. But I think at the risk of oversimplifying, that is one of the things you are trying to do with cost of equity, is say, okay, this is my hurdle rate, essentially.
Yep. Yeah, that's very well said. That's exactly what it is. And I think the thing that you have to understand when you invest in the stock market is there is always a risk and there's always a cost of doing business. There is no free lunch, as Andrew likes to say. And so every company that you invest in, there is a cost to investing in that company. And you have to figure out what that cost is, whether it's using the mathematical formula or whether it's using hypotheticals. You have to decide how much risk is involved in this, and what is the cost of me buying this versus this. Just like if you there's a cost to buying a hamburger versus there is a cost to buying a salad. One may be more expensive than the other, but to your health, there's a cost to that. The hamburger arguably is less healthy than the salad. And so for your long-term health, buying the hamburger has a worse impact on you than buying the salad would. And but then you have to offset, do would I enjoy eating the hamburger more than I would enjoy eating the salad? And you may. And so that goes into the calculation, shall we say, of investing in a stock. And so when you think about investing in a company like Nvidia or investing in United Health Group, then there are two different costs to investing in those, and you have to understand that, because the return that you should expect from one versus the other, you would hope would be bigger than the other, because you're taking on more cost to invest in one than the other. And so those are things that I think you need to really think hard about when you're investing. It's really hard to go over the numerical, like the formula on the podcast. It's a lot easier to talk about the theory of it, as opposed to here's how you calculate it and you do this and you add this number and add this number, because you guys can't see us. So that makes it a little more of a challenge.
Can I add a few though?
Yeah.
So a couple big factors that will change the cost of equity, and I'll just give two because it'll make it simpler. If interest rates are higher, the cost of equity is higher. The reason for that is if I can earn 7% in a savings account instead of 4% because interest rates went from 4 to 7, then my cost of equity just went higher, because why I better be able to make higher than 7% because I can make 7% in a savings account. So when interest rates go higher, cost of equity goes higher for everybody. And sometimes that's why you see the stock market come down, trade at lower multiples, lower valuations, because the cost of equity and the valuation are inversely correlated. So the higher the cost of equity, the higher the cost of that cheeseburger, that quadruple artery clogging cheeseburger, the higher that is, the cheaper the stock market will become, and vice versa. The less costly, the more of a price people pay for stocks. And I guess the other risk to go along with that is beta, which is another way of saying volatility, which is another way of saying how uncertain are the cash flows that you're projecting into the future. I could make very, very, very optimistic assumptions about where a stock is going to be. I could assume that this stock is going to go from $3 million to $300 billion. If I'm like just doing that in a formula and not thinking about cost of equity, I might have a problem there. So you do want to think about uncertainty too in the cost of equity.
Yeah. Yeah, that's a great explanation, and I think a lot of people don't realize the impact that interest rates have on the stock market and why it drives valuations higher or lower, and that's a big reason why. And the when to Andrew's point, when the rates go down, that's why you see people get so excited about the markets, because now the cost to invest in a stock is lower, and so the return that you could get could be higher. And the when people think about interest rates, it I like to think about two things. So the first is what Andrew was talking about, how it impacts kind of the comparison to putting money in a government bond versus investing in the stock market. If you can get a stock that's going to give you a 5% return, but your a T bill from the government is 4.5, why would you take that extra risk to invest in the stock when you get just as good a return from the safer T bill? You wouldn't, and that's why people, when the rates are higher, that's why they flock to some of those more safer assets, if you will. But when rates go down, they flee those because the returns are less and you can get a better return in the stock market. The other part of the equation is that when interest rates are lower, that means that borrowing money is now cheaper. And that means that businesses that have opportunities to reinvest can go out and borrow cheaper money to grow their business faster. And they can leverage their business by using debt to improve their returns. And so when rates go down, you see borrowing go up. And that is another impact of why people get excited about the markets, because they see the rates going down and they know intuitively that companies can borrow more money to lever up their returns. And that's exactly what we saw during the pandemic. You saw these companies borrowing a crap ton of money at, 0.5% or 1%. It's just, insanely low numbers. And why wouldn't you? They kind of be an idiot not to. But now that rates are a lot higher, that activity slowed down a lot. And so that's why the markets, when they see the Fed cut, that's why everybody gets all excited about it. So, and that all plays into the cost of equity of a business.
Super good points. If you're a beginner and you're curious about cost of equity and you want to go down that rabbit hole, what do you recommend that people do?
I think there are two things. Number one, you go to our website, einvestingforbeginners.com, type in cost of equity at the search bar, and you'll find multiple articles written by Andrew and I and others that explain cost of equity. And I think we do a fairly decent job of breaking it down so that like us normies can figure it out. If you really want to go into the weeds and really want to wade into things like beta, then check out Professor Aswat Damodaran's website. He has a website, I think it's called damodaran.com. And that has a link to all his all his class notes, as well as his lectures and other papers that he's written about all these things. And he will, if you want to get in the nitty gritty, he'll give you the nitty gritty. So that's what I would recommend.
And great YouTube videos too.
Yeah. Yeah. Fantastic YouTube videos. Very helpful. All right. Well, with that, we will go ahead and wrap up our Q&A for today. If you have any questions or if there's anything you'd like us to discuss on the show, please don't hesitate to reach out to us. You can send us questions at newsletter@einvestingforbeginners.com, or you can also leave us questions on the Spotify app. It's a great new feature that they've offered. And we will read the questions. And if we feel like they could be helpful, we'll read them on the air and answer them for you. So with that, we will go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.